History doesn't always repeat itself, but 2025 is starting to look a lot like 2022 before both stocks and bonds crashed. Fiscal stimulus, debt ceiling, inflation, retail stock mania. Why we shouldn't expect the Fed to make the same mistake again. Why Trump needs big beautiful tariffs to pay for his big beautiful bills. What should you be doing with your money right now? Defying policy uncertainty and trade tension, the global economy surprisingly is still trucking along. The JP Morgan Global Composite Purchasing Managers Index rose again in June for the second consecutive month. While the service component of the index was barely lower than in May, the manufacturing component swung into expansionary territory for the first time in 3 months. Wall Street economists have been busy revising up their growth forecasts for most of the major economies. Brazil and China have led the pack in upward revision. But the UK and the Eurozone are not too far behind. Wall Street economists are also revising down their inflation forecast. Markets are definitely less and less concerned about the risk of stagflation. Credit spreads have narrowed, and Treasury spreads now imply low probability of recession this year. If anything, the fact that so many cyclically sensitive sectors of the US stock market have done so well lately implies that the market is positioned for the economic upswing to continue. Will the market be proved right? One thing is clear. With the market no longer worried about a slowdown, weaker data will be the pain trade in the coming weeks. If the global economy has withstood the shock of Trump's trade war so far, it has a lot to do with the fact that global trade has held up incredibly well. South Korea is the first country to release trade data every month. In June, South Korean exports grew 4.3% compared to a year ago. Japan has yet to release the trade data for the full month of June, but in the first 20 days of the month, Japanese exports picked up, growing 0.7%. We don't have the June data for China yet, but Chinese export grew 4.8% in May, following an increase of 8% in April. The elasticity of import substitution for the US is estimated to be somewhere between 1.8 and 7. So why haven't we seen bigger impact of Trump's tariff on global trade? S&P Global's June PMI survey noted that a renewed rise in global manufacturing output was driven partly by stock building efforts ahead of the tariff deadline in July. It observed unusually high inventory building in the US amid tariff worries. This is consistent with the reporting by Descartes that US container import volume recovered somewhat in June after a sharp drop in May. But there was no recovery for containers originating from China. Indeed, according to Descartes, China's share of US container imports fell to a 4-year low in June. How do we explain the resilience of Chinese export growth then? A sharp drop in Chinese exports to the US over the past 3 months has been noticeably offset by increase in Chinese exports to ASEAN countries and to the EU. Since the US-China trade war during Trump's first term, ASEAN has surpassed both the EU and the US to become the largest destination for Chinese exports. As others and I have noted, a big part of this increase is transshipment to the US, as Chinese exporters use countries like Vietnam as a backdoor into the US. It is reasonable to think that these backdoors are why Chinese overall export growth has held up so incredibly well over the past 3 months, despite a doubling of US tariff. This is probably also why Beijing reacted so furiously to the trade agreement reached between the US and Vietnam last week. In the deal, Vietnam agreed to a 40% tariff on transshipment to the US. How soon the deal will be finalized and implemented is not clear. Nor is it clear how transshipment will be defined and the tariff enforced. It will take some time, but the news is tightening for Chinese exporters. All this says to me is that a downturn in global trade and manufacturing is still ahead of us. We should be careful not to confuse a dead cat bounce with green shoots. What it also says to me is that there will be no easy trade deal between the US and China before the August 11th deadline. Tariffs are a tax. It is a fact that the US government has collected $50 billion more in tariff revenue over the past 3 months. Whoever is paying the tariff is $50 billion out of pocket, which is equivalent to $200 billion on an annualized basis. The fact that US import prices are holding firm suggests that it is Americans and not foreigners who are paying the tariff bill. What is also clear is that with core goods inflation unchanged in April and May, tariffs have not yet been passed on to US consumers. What all this means is that either US importers will have to take a hit on their operating margins, or that price increases are on the way. The fact that this has not yet happened does not mean that it won't. It just means that the buildup in inventories ahead of Trump's trade war has provided a buffer for many businesses. But as the buffer disappears, the economic effects of the tariff will start to be felt, especially as it is becoming clear that tariffs are here to stay. Trump will need big, beautiful tariffs to pay for his expensive, big, beautiful bill. This is my reason why an average tariff of 20% is likely the new normal. I think very soon American businesses will have to decide whether to pass on the cost onto the consumers or to cut back on hiring and capex. Toyota, with 15% of the US auto market share, announced at the end of June that it would start raising prices in July. Meanwhile, used car prices notched the biggest increase in nearly 3 years in June. Stagflation is not a question of if, but when. The most important takeaway from the S&P Global June Manufacturing PMI survey for the US was a further acceleration in both input prices and output prices. The pattern is not dissimilar to what we saw in 2021, just before US inflation began to take off. In 2021, the market was persuaded by Janet Yellen and the Fed that rising inflation was transitory, so stocks kept rallying. Today, the market is taking heart the Fed's forecast of 2 rate cuts before year end, and stocks are rallying on the view that Trump doesn't have the stomach to go through with his tariffs. The big equity sell-off at the start of 2022 was triggered by a spike in rates as the Fed finally started to change tune. This time, the hurdle for the Fed to change tune is much lower. The stimulus in the big beautiful bill will only compound their concern about the impact of tariff on inflation. Remember, Janet Yellen also said that she didn't think Biden's fiscal stimulus package in 2021 was going to have much impact on inflation. History seems set to repeat. Not to mention that just like at the end of 2021, Congress just voted to increase the debt ceiling that will see a big increase in issuance. Rates will go up and stocks will go down. The retail-driven AI mania is buying time for the equity bulls, but it feels like we're getting closer to that inflection point. Stay tuned. Thank you for listening.